Introduction to Auditing, Origin of Assurance Services. Since the Industrial Revolution in 18th century, businessmen started forming joint stock companies to do business. Usually, people who manage the company, called management or directors, are separate from those who own the company, called shareholders. To judge the performance of management and directors, shareholders ask them to prepare and present them financial statements. Soon after, it was realized that financial statements prepared by management and directors presented best view of the business instead of true and fair view, due to some incentives, e.g. bonus, or pressures, e.g. fear of removal, faced by those charged with governance. Thus, credibility of financial statements was questioned. To enhance the credibility, confidence, and assurance on these financial statements, an expert person, called assurance provider or auditor, was hired by shareholders to check and verify financial statement. Auditor is independent of both management and shareholders. Services of the auditors were appreciated greatly. Nowadays, assurance engagements are performed either because they are required by law, called statutory assurance engagements, e.g., most companies are required by law to get their annual financial statements audited before they are available to shareholders, or they are not required by law but are voluntarily performed because of its advantages, called non-statutory assurance engagements, e.g., audit of sole proprietorship, partnerships, not-for-profit organizations, and small companies conducting an audit. Relationship between shareholders and directors and management. Following concepts explain the nature of relationship of directors and management with shareholders. First, steward. Stewardship is the practice of managing other person's property. The directors have a stewardship role. They look after the assets of the company and manage them on behalf of shareholders. Second, agent. An agent is an individual who acts on behalf of the principal. In a company, directors are agents and shareholders are principal, i.e., directors act in accordance with instructions and in best interest of shareholders, and are accountable to shareholders for their acts. Third, accountable. As agents of the shareholders, directors are accountable to shareholders. Directors show their accountability to shareholders by preparing annual financial statements and presenting them to shareholders for consideration. Advantages of assurance engagements. 1. It increases credibility of financial statements as most of the misstatements are identified. 2. It confirms that management is performing its statutory and non-statutory duties. 3. Auditor identifies deficiencies in entity's internal control system and gives recommendations to management to improve it. 4. It assists in sale or purchase of business. 5. It assists in grant of loan by bank or loan providers. Definition and elements of assurance engagement. Assurance engagement means an engagement in which a practitioner, say auditor, obtains evidence about evaluation of a subject matter, say financial statements, against suitable criteria, say financial reporting framework, and expresses his opinion to enhance the confidence of the intended users, say shareholders, other than the responsible party, say management. Elements of assurance engagement. A. Three-party relationship. I. Intended users, the parties who require subject matter and assurance report, e.g. shareholders. I2. Responsible party, the party which is responsible for preparation of subject matter, e.g. management. I3. Practitioner, the professional who verifies subject matter and provides assurance on it, e.g. auditor. B. A subject matter. Subject matter is the information prepared by a responsible party for intended users and is checked and verified by the practitioner, e.g. financial statements. C. A suitable criteria. Criteria means framework or basis, e.g. standard rules and regulations like International Financial Reporting Standards, which is used to prepare financial statements. D. Evidence. Evidence is the information used by practitioner in arriving at the conclusion on which his report is based. Whatever is reported should be supported by sufficient and appropriate evidence. E. Written assurance report. It is a report written in standard format, as per international standards on auditing or as per the local laws, which includes conclusion of practitioner. It is provided by practitioner to intended users through management. If any of the above element is missing, engagement will be called non-assurance engagement. Levels of assurance and why absolute level of assurance cannot be provided. Assurance means confidence. There are 3 levels or degrees of assurance depending on amount of work performed and results of that work. 1. Limited assurance, also called moderate level or negative assurance. It is moderate level of assurance, expressed in negative form of conclusion, e.g., based on our review, nothing has come to our attention that causes us to believe that accompanying financial statements do not give true and fair view in accordance with international financial reporting standards. This level of assurance is usually given in review of historical financial statements. Reasonable assurance, also called high level or positive assurance. It is a high but not absolute level of assurance expressed in positive form of conclusion, e.g., in our opinion, financial statements give true and fair view of financial position of ABC Limited at December 31, 2026, and its financial performance and cash flow for the year then ended, in accordance with international financial reporting standards. This level of assurance is usually given in an audit of historical financial statements. Reasonable assurance means auditor does not certify or guarantee that financial statements are free from all misstatements. There may still be some undetected misstatements even after the audit due to inherent limitations of audit. 3. Absolute assurance cannot be expressed or provided. Absolute assurance means certification or guarantee that financial statements are free from all misstatements. Auditor cannot provide absolute assurance because most of the audit evidence is persuasive rather than conclusive, due to the inherent limitations of the audit as follows. A. Nature of financial statements, e.g. estimates, judgments, and uncertainties are involved in preparation of financial statements. B. Nature of audit procedures. I. Management may not provide complete information to auditor. I. Auditor does not have legal powers to search. I. Fraud involving collusion and complex techniques or involving senior management are harder to detect. 4. Time and cost limitation. Therefore, auditor plans audit in such a way that he directs its efforts on risky areas. And that is why auditor uses sampling rather than testing 100% transactions in each area of financial statements. 5. Many of the audit procedures are based on auditor's judgment, which can be faulty. 6. There are always some limitations in client's internal control system. 7. The disruption caused to a company's staff during the audit. Introduction to International Foundation for Ethics and Audit, IFIA. The International Foundation for Ethics and Audit, IFIA, is a no-profit organization. It supports high-quality standard setting in ethics, auditing, and assurance. Boards of IFIA. IFIA works through 2 standard-setting boards. A. International Auditing and Assurance Standards Board, IAASB. B. International Ethics Standards Board for Accountants, IESBA. International Auditing and Assurance Standards Board, IAASB. The IAASB is an independent board within IFIA. It develops and promotes international standards for auditing, assurance, and related services. Roles of IAASB: develop and issue international standards on auditing, ISAs, and other related standards. B. Facilitate adoption and implementation of these standards worldwide. C. Enhance the quality and consistency of auditing and assurance practices. Strengthen public confidence in the global auditing profession. Types of international standards issued. The IAASB issues 5 main types of standards, each serving a different purpose. ISAs, International Standards on Auditing, applied in audits of historical financial statements. ISREs, International Standards on Review Engagements, applied in reviews of historical financial statements or prospective financial information. ISAAEs, International Standards on Assurance Engagements, applied in assurance engagements other than audits or reviews, that is, non-financial information. ISREs, International Standards on Related Services, applied in compilation, agreed-upon procedures, and other related services. For example, tax return preparation and filing, fraud investigation, etc. ISQMs, International Standards on Quality Management, applied to all of the above services to ensure quality in firms' systems and engagements. And IAPSs, International Auditing Practice Statements, which provide interpretive guidance and practical assistance to auditors in implementing international standards on audit. International Standards on Auditing, ISA's process of developing and issuing a new ISA. The IAASB follows a structured process to ensure quality and acceptance. A subject is selected for detailed study. B. After research and exposure draft is prepared. C. The exposure draft is approved by the IAASB and circulated for public comments. D. Comments and suggested changes are reviewed. E. The revised draft is finalized and the new ISA is published. Contents of ISAs. Each ISA includes three main parts. 1. Introductory material, objectives, and definitions. Provides background and purpose. 2. Requirements, essential procedures auditors must follow. 3. Application and other explanatory material. Additional guidance, examples, and appendices. Authority and status of ISAs. To achieve reasonable assurance, auditors must follow all requirements of all ISAs. Exception to follow requirements of ISA. A required procedure will not be performed if it is not relevant or not practical. However, if a procedure is not practicable, auditors shall document reason of departure from required procedure and alternative procedures performed to obtain evidence or assurance. Key concepts. Independence of the auditor. Independence means auditors should be free to perform audit procedures without any bias or influence. Auditors should be independent of financial, personal, and employment relations with client. True and fair view. Term true and fair view or fair presentation have no legal definition. Generally, true means free from errors, and fair means free from undue bias in preparation or presentation of financial statements and comply with the applicable framework. Materiality. Information is material if its omission or misstatements could affect the decisions of users. Materiality refers to the significance of information. Auditor focuses on significant items in financial statements instead of checking every transaction. Planning of an audit. Planning an audit means setting the direction of the work before starting detailed procedures. It involves two steps. First, establishing the overall audit strategy, setting scope, timing, and direction of the engagement. And second, developing the audit plan, describing the nature, timing, and extent of audit procedures to be performed on each area of the financial statements. Who is involved in audit planning? Audit planning is a team activity. The engagement partner and other key members of the engagement team must participate. Why planning is important? Planning helps the auditor to: first, complete the engagement efficiently and effectively. Second, identify and resolve potential risks and problems on time. Third, focus on important and high-risk areas. Fourth, select the right team and assign work properly. Fifth, direct, supervise, and review work of staff appropriately. Sixth, coordinate smoothly with competent auditors and experts, if any. Documentation of planning. The auditor must documentation. The overall audit strategy. The audit plan. Any significant changes made during the audit, along with reasons for the change. Difference between overall audit strategy and audit plan. Overall audit strategy. The overall audit strategy sets the scope, timing, and direction of the audit. It guides the development of the audit plan. Key matters documented in the audit strategy include: 1. Engagement characteristics, applicable financial reporting framework, e.g. IFRSs. B. Industry-specific requirements. C. Number and location of business components. D. Need for specialized knowledge. E. Whether the entity has an internal audit function and how the work of internal auditors will be used. F. Effective information technology on audit procedures. G. Availability of client personnel and data. H. Use of audit evidence obtained in prior periods. 2. Reporting objectives and communication. A. Reporting deadlines of the entity. B. Meetings with management and those charged with Gov. C. Nature and timing of auditors' reports and other communications. Management letter, communication with TCWG, reports from component auditors. 3. Factors directing team efforts. A. Materiality thresholds. B. High-risk areas. C. Decision whether to rely on internal controls or focus on substantive procedures. D. Recent development in law, accounting, or industry. E. Emphasis on professional skepticism in certain areas. 4. Resources required. A. Timing of resources, e.g. whether to use staff during interim audit. B. Level of staff and expertise required for high-risk areas. C. How to direct, supervise, and review team members. 5. Preliminary engagement activities. A. Knowledge from prior audits and procedures performed at acceptance, continuance stage. B. Results of these preliminary engagement activities. Audit plan. The audit plan is more detailed than the overall audit strategy. It translates the board approach into specific procedures for each financial statement area. The plan includes The nature, timing, and extent of the planned risk assessment procedures. Further audit procedures at assertion level. Tests of controls, if the auditor plans to rely on the controls.
Substantive procedures, depending on assessed risks.
Audit plans are usually presented in the form of audit programs, step-by-step instructions to audit staff. Additional planning considerations for initial audit engagement. Planning for an initial audit requires more effort because the auditor lacks prior experience with the client. To reduce the higher audit risk, the auditor performs extra procedures before starting. A. Perform acceptance procedures, check client integrity, competence of firm, and ethical compliance. B. Discuss major issues with the management, e.g. disagreements on accounting policies, scope limitations, and communicate their effect on audit planning to TCWG. C. Communicate with the predecessor auditor, and if allowed, review their working papers. D. Obtain sufficient and appropriate audit evidence to ensure the audit can proceed. D. Audit evidence regarding opening balances. E. Apply additional quality control measures such as independent review by another partner. Interim audit versus final audit. Interim audit. An interim audit is performed before year-end. It mainly covers systems and transactions up to the interim date. Typical procedures include understanding the entity and assessing inherent risk, documenting and testing internal controls, performing preliminary analytical procedures, testing profit and loss transactions up to interim date, identifying potential issues for the final audit. Advantages of interim audit include earlier identification of significant matters, flexible resource planning, quicker reporting for stakeholders, reduced workload at year-end, leading to higher efficiency. Final audit. A final audit takes place at or after year-end. It concludes with the auditor's opinion on the financial statements. Typical procedures include agreeing financial statements to accounting, examining adjustments made during preparation of statements, ensuring proper cutoff for sales and purchases, substantive testing of transactions after interim date up to year-end, sending external confirmations, e.g. banks, lawyers, debtors, creditors, etc., obtaining management representation letter, attending inventory count, reviewing subsequent events, performing final analytical procedures, and reviewing going concern assumption. That's all for this video. Thanks for watching. Till next video, Allah Hafiz.